Welcome to TalkTickers. We dive into earnings calls so you don't have to, bringing you the key insights experienced investors need.
We cut through the noise, basically.
Exactly. Today, it's Carrier's first quarter 2025 call.
Yeah.
We'll hit the highlights, then really dig into the numbers, their strategy, what they see coming.
Right. Full picture.
So
Yeah.
let's get straight to it. What's the big takeaway from Q1?
Well, Carrier kicked off the year strong. Really strong, actually. Beat expectations.
Yes.
Orders were up high single digits overall, and you saw double-digit growth, really impressive, in Climate Solutions Europe and also transportation.
And what about the U.S.?
Climate Solutions America, yeah, they saw about 20% sales growth. That was in both residential and commercial, which, helped offset some weakness they had in light commercial. And their global aftermarket, that continues to be a powerhouse, up 8%. They think it's on track for another double-digit growth year.
Wow. So demand looks solid?
Definitely. The total company backlog reflects that. It's up around 10% compared to last year, and maybe more importantly, up 15% just from the last quarter.
15% sequentially. Okay. That points to future work.
Yeah, exactly. Strong pipeline.
So that's the top line. How did it translate to profits? Did efficiency play a role?
Huge role. Productivity was really strong. They got almost 100% core earnings conversion.
100%.
Pretty much. And margins expanded nicely, 210 basis points.
That's significant margin expansion.
It is. And it led to, get this, 27% growth in adjusted EPS, earnings per share, even though organic growth, like underlying sales, was only up 2%.
So they're making more profit from each dollar of sales.
That's the story, yeah. Operational efficiency really shining through.
And were they just focused internally? What about the financial side, balance sheet, shareholders?
No, they were active there too. Generated $420 million in free cash flow. Good number.
Okay.
And for investors listening, they returned a lot of capital, $1.5 billion. That was through dividends and share buybacks.
Right. Always good to see.
And they paid down debt, $1.2 billion. Strengthens the balance sheet, give them flexibility. No major debt due till 2027 now.
Okay, so strong start, good efficiency, shareholder returns, less debt. Sounds positive. Did this change their outlook for the whole year?
It did, yeah. They bumped up their full-year adjusted EPS guidance, now looking at $3 to $3.10 per share.
Which is what kind of growth year over year?
That's about 20% growth compared to last year. So yeah, management's clearly feeling confident.
Okay, that's a solid high-level view. Let's peel back the onion a bit. What's really driving these results? You mentioned strategy, specific products.
Yeah, a few things stand out. They're making real progress with what they call differentiated products, things that set them apart.
Like what?
Well, in Europe, they launched their first air-cooled commercial heat pump. Big deal over there with the energy transition.
Right, heat pumps are huge in Europe.
Exactly. And on the residential side in Europe, they're getting traction with their own Carrier-branded heat pumps. They're using the Beijing Ref channel. That's a big distributor network they acquired to push those out.
Makes sense. Leveraging acquisitions. And you mentioned aftermarket strength earlier. What's the secret sauce there? Still going strong.
It really is. It shows the value of having all that equipment installed out there. Think about commercial chillers. They now have service contracts, attachment rates over 60%.
60%. That's a lot of recurring revenue.
Huge recurring revenue stream. Plus, they've got over 50,000 chillers connected to the cloud.
So they can monitor them remotely.
Yep. Proactive maintenance, better service. Their overall commercial HVAC aftermarket globally up about 10%. And the mods and upgrades part of that grew around 20%.
So customers are investing in existing systems too?
They are, extending life, improving efficiency. And even in transportation, they launched a new smart device app for their Lynx fleet system. Better service there too, presumably.
It also feels like they're selling complete systems, not just components, especially in Europe with Siemens Pro.
Absolutely. Siemens Pro is helping drive that heat pump adoption in Europe, and the economics are compelling. Selling a heat pump versus a boiler, that's like 4 times the revenue.
4 times.
Yeah, and if they sell the complete system, it's more like 8 times the revenue compared to just a boiler.
Wow. Big incentive.
Big time. And then there's the tech angle. They're partnering with Google, integrating Carrier's home energy management, EMS, with Google Cloud AI.
What's the goal there?
Smarter homes, better energy management, potentially helping the grid, especially during peak times in the U.S. It's about integrated, smarter solutions.
Interesting. Okay, let's look regionally. Europe's residential and light commercial, RLC. How did that perform?
Okay, Europe RLC. Orders were actually up mid-teens organically.
Despite economic concerns.
Yeah, driven almost entirely by heat pumps. That offset the decline in traditional boilers. Germany is a key factor. Lots of applications for heat pump subsidies there.
So government policy helping.
Definitely. And their backlog in that segment, it jumped 60% just from Q4. Huge sequential increase.
60% backlog jump. Wow. But sales were down in Q1.
Sales were down about 10% organically in Q1. Yeah, but that was expected. They're actually projecting modest growth in Q2. And they said the integrations like VMen are on track, hitting synergy targets. They sound positive about Germany's climate goals, keeping that momentum going.
Okay. Now, tariffs. Always a hot topic for global companies. How's Carrier handling that? Seems like less of a headwind now.
They seem to have managed it pretty well, actually. Most of their Mexico imports are USMCA compliant, so no big issue there.
Yeah.
China's the main exposure, about 80% of the remaining tariff impact. But they said they've basically mitigated almost all of it.
How?
Through supply chain moves, productivity gains, optimizing where they manufacture things, and they're tightening belts elsewhere, like G&A costs. The bit that's left, around $300 million, they're covering with price increases.
$300 million through price.
Yeah.
How much is that overall?
It works out to just over 1% additional pricing on average. So they seem to have neutralized most of the tariff pain through other actions.
Right. Sounds like proactive management. Okay, let's dive into the segment financials for Q1. Give us the breakdown.
Sure. So total company, as we said, $5.2 billion in reported sales. That's 2% organic growth. Adjusted operating profit up 10%. Margin expansion, 210 basis points.
And part of that margin bump was because they exited commercial refrigeration, right?
That was a tailwind, yeah. Adjusted EPS, Brank went 65 cents. Free cash flow, $420 million. And the buybacks, $1.3 billion in Q1, another $320 million in April. So they're well on their way to that $3 billion target for the year.
Okay, now segment by segment. Climate Solutions Americas, CSA, looked strong.
Very strong. CSA organic sales up 9%. Good mix of volume and price helping there. Commercial HVAC and residential HVAC both up around 20% organically. Really impressive.
But light commercial was down.
Yeah, light commercial was the weak spot, down about 35%.
Why such a big drop?
Couple of reasons. Tough comparison to a really strong quarter last year. Plus, they saw softer spending from small and medium businesses and some delays in K-12 school projects getting funded.
Okay, makes sense. But margins were still strong in CSA.
Margins expanded massively, 420 basis points, huge improvement. For the full year, they nudged up the organic sales guidance slightly for CSA, mostly because of that tariff-related pricing, but it's somewhat offset by expecting lower light commercial volume for the year.
Got it. What about Climate Solutions, Europe, CSE? You mentioned margin pressure there earlier.
Right. CSE organic sales were down 7% overall. Commercial HVAC in Europe actually grew mid-single digits, which is good. But the RLC side, residential and light commercial, was down about 10%.
And that hurt margins.
Yeah, the lower volume and mix, plus they're still investing in the business. That led to the adjusted operating margin decline in Q1. But they sound pretty focused on fixing it, addressing some underperformance in the legacy Carrier RLC business, plus finding more synergies on the commercial side from acquisitions. They expect volume to pick up, which should help margins recover.
Okay. And Asia, Middle East, and Africa? CSM. Seemed like a mixed picture.
Yeah, a bit mixed. CSM organic sales down 6%. They saw weakness in residential, particularly in China and Southeast Asia, but Japan and India showed growth.
China specifically.
Residential China down around 20%. Commercial China was actually up low single digits, but again, tough comparison to last year. The positive, though, was that CSM expanded its margins despite the lower sales.
How'd they manage that?
Productivity gains within their operations and favorable currency movements helped too.
Okay. Lastly, transportation, CST.
CST was up 2% organically. The container business was strong, up 20%. That offset a dip in the global truck and trailer market, which was down low single digits overall.
Any regional differences in truck trailer?
Yeah, Asia was strong there, but North America and Europe were down. Importantly, CST margins expanded, helped significantly by exiting that lower margin commercial refrigeration business. They're guiding for mid-single-digit organic growth for transportation for the full year.
Okay, solid breakdown. Looking forward, what specifics did they give for Q2 and the full year guidance beyond the EPS bump?
For Q2, they're targeting sales around $6 billion. They expect about 100 basis points of adjusted operating margin expansion, so continued improvement there, and adjusted EPS growth around 20%, similar to Q1's performance.
And the full year margin and cash flow.
Full year adjusted operating margin expansion target stays at about 100 basis points. And the free cash flow target remains $2.4 to $2.6 billion. So holding steady on those key metrics.
What about VM within Europe? Any change to their outlook there given the market shifts?
Interestingly, no. They're still expecting flat growth for VMAN for the full year. They think even if total unit deliveries in Germany are a bit lower than first thought, a better mix, more higher value heat pumps will offset that.
And margins for VMAN?
Still confident in achieving low teens operating margin for the year.
Okay. The commercial HVAC business, especially in the Americas, sounds like a real growth engine. Can you expand on that?
Absolutely. It's a powerhouse.
Yeah.
They expect their 5th straight year of double-digit growth globally in commercial HVAC.
Wow. What's driving that?
Data centers are a huge piece. They initially expected $500 million growth from data centers this year. Now they expect that to double to $1 billion.
Doubling data center revenue expectations.
Yeah, massive acceleration. But even excluding data centers, they expect the rest of commercial HVAC to be up high single digits. They mentioned freeing up sales teams now that capacity constraints are easing.
So focusing beyond data centers too.
Right. Seeing strength in mega projects, healthcare, pharma, electronics manufacturing. Office buildings are still weak, though. That hasn't changed.
Makes sense. Now, the big refrigerant transition in U.S. residential, the 454B shift, how's that going? Any issues?
They said Q1 momentum was good. Price realization is on track. They actually think they gained some market share. Distributor inventory levels are a bit higher than last year, so they're watching that.
Any supply chain hiccups? Like those canisters?
Yeah, there was some concern about canister availability, but they expect that shortage to resolve here in Q2, so seems manageable overall.
Good to hear. And back to data centers quickly, they mentioned a new product, Quantum Leap.
Yeah, that's their big play in advanced cooling, likely liquid cooling. They said they're in early stage bids with it. They've also developed their own coolant distribution unit, or CDU. They sound very bullish on the potential there long term.
Okay. Free cash flow was strong in Q1, stronger than usual seasonally. Why was that?
It was mainly about working capital. Payables weren't as much of a cash use as they typically are in Q1. That helped offset the usual seasonal inventory buildup. So a bit of timing benefit there, perhaps.
Got it. And services, they seem really committed to that double-digit forever idea.
They really are. It's a core part of the strategy. They're working on harmonizing operations globally, driving productivity, creating unique offerings. Attachment rates, especially on commercial chillers, are way up.
And mods and upgrades, too.
Growing focus there, yeah. They sound very confident they'll hit double-digit growth again this year in services. It's that stable, recurring revenue stream they value.
Let's just quickly revisit tariffs one more time for clarity.
Sure. Basically, Mexico imports, mostly fine under USMCA. The rest, mainly China. They've used supply chain tweaks, factory optimization, productivity gains, cost cuts like G&A. All that has offset almost everything except for about $300 million.
And that $300 million is being covered by?
Price increases, mostly in the Americas residential market.
Okay, clear. Now, that light commercial weakness in North America, how concerned should investors be? Sounded pretty significant.
It was a big drop in Q1, yeah, down 35%. And they said Q2 started weak too. They do expect a recovery in the second half, but for the full year, they're now guiding for light commercial to be down double digits.
So a full year decline expected now. What's the main reason again?
Primarily cautious spending by small and medium businesses, and also delays in K-12 school bond funding coming through, which usually drives replacement cycles for those kinds of systems.
Right, that makes sense.
Okay.
One last deep dive point, the Google partnership. It's more than just smart thermostats, right?
Yeah, the focus is really on demand response, using smart HVAC, especially with more heat pumps coming online, to help balance the electricity grid during peak hours.
How does Google fit in?
They're using Google's AI and analytics to automate the control of these systems for better efficiency and grid interaction. It's a potential win for Carrier, Google, the utilities, and homeowners. Still early days, but they see a lot of interesting use cases down the road.
And they'll probably talk more about this at their Investor Day.
Exactly, May 19th. Expect more detail on growth strategies from the CEO, CFO, and segment leaders then.
Okay, great. So let's pull it all together. If you're an investor looking at Carrier after this quarter, what's the overall picture, the key takeaways?
Well, the strong Q1 and the raised guidance definitely signal positive momentum, even with economic uncertainty hanging around. Orders are strong, especially in those key growth areas like European heat pumps and transportation.
And they're managing challenges?
Seems like it. The way they handled tariffs shows proactive management. And that relentless focus on aftermarket and services, that's building a really solid recurring revenue base.
Plus the future growth areas.
Right. The data center push looks very promising, positioning them well for a major trend. But, you got to watch the weak spots.
Like light commercial.
Yeah, North American light commercial needs monitoring. And the margins in European RLC, while they have a plan, need to show improvement. The Investor Day might shed more light there. And that Google partnership, while early, shows they're thinking about innovation and future tech integration.
Okay, makes sense. Now for the fun part. Time to put on our speculative thinking caps. Remember, everyone, this is not financial advice. But based on this carrier call, what's an outrageous but plausible trade idea you've cooked up?
All right, outrageous but plausible idea number one. Given that huge push into data center cooling, the Quantum Leap product expecting to hit $1 billion in revenue there.
Yeah, that doubling was eye-catching.
Exactly. So maybe consider looking at a smaller public company that makes specialized power distribution units, PDUs, specifically designed for the kind of high-density data centers that use liquid cooling.
Ah, so not Carrier itself, but a supplier further down the chain.
Right. The idea is, as Carrier and others deploy more liquid cooling, the demand for the specialized power infrastructure needed to support it could surge. This smaller PDU company could benefit massively, maybe even become an acquisition target itself.
Interesting angle. Playing the ecosystem. High risk, though.
Oh, definitely speculative. High risk, potential high reward. Needs serious homework if you are actually considering it. It's just a thought starter.
Got it. Outrageous but plausible. Okay, that wraps up our deep dive into the Carrier Q1 2025 earnings call.
We covered the key numbers, the strategies, the outlook.
Hope this gave you some valuable insights. Remember, it's just information, not advice. Always do your own research before making any investment moves.
Yeah, absolutely. What stood out to you? Let us know your thoughts on Carrier's path forward.
Thanks for tuning in to TalkTickers. We'll catch you on the next Earnings Deep Dive.